Okay, welcome back, everybody. Today we have Amanda Han of Keystone CPA. And Amanda, if you don't mind giving us a 60-second introduction of who you are and what you do.
Yeah, well, thanks for having me, Ryan. Super excited to be here and share how we can all use short-term rental investing to not just build wealth, but also save on taxes. My husband Matt and I founded Keystone CPA, which is our accounting firm. And so, unlike traditional CPAs, we focus mainly on tax strategy, which is basically what are all the things that you could be doing or should be doing during the year to save a significant amount of taxes. We work with clients nationwide, from new investors all the way to people scaling big portfolios. And what I love about the short-term rental space is that the tax strategy associated with short-term rental works for virtually everyone. Like there's almost no one it does not work for. You can be a W-2 earner, you can be a business owner, you can be a realtor, low income, middle income, very high income. It works for everyone. So excited to dive in.
Yes, I'm so glad you're here. And you're actually opening up a whole conversation that we'll get to right now. So it's the rep status, real estate professional status versus someone that doesn't qualify for that. So first, what is the rep status? And what do you mean by anyone could qualify for these advantages?
Sure, sure. Well, I'll kind of start with the fact that, when we buy real estate, a lot of times I'm going to use the word tax losses. And when I say tax loss, I simply mean losses that are strategically created on paper, right? Because first and foremost, we're always looking to invest in profitable real estate investments. And then
Yep.
through strategies like write-offs and paper losses like depreciation, we create a loss for the IRS to see. Normally, when we invest in rental real estate, we'll call it traditional real estate, right? There'll be single families, multifamily. They're usually long-term holds where the tenant is going to be there for a year or longer. Usually, those losses that we create are considered passive. And what that means is I can only use it to offset passive income that I generate from maybe other passive investments. So what that also means is if I have passive losses and I have high W-2 income, for example, they kind of live in two different worlds where one does not offset the other until some future point in time. And that is true for all investors, except that you can overcome that limitation if you or a spouse is a real estate professional. Okay. And so for people who invest in long-term rentals, it's important to try to qualify as real estate professional, because when you qualify, then rental losses offset all types of income, including W-2. The hurdle, though, is to be a real estate professional, there's several rules that you need to meet. One of which is you have to have more time in real estate than your job. So for anyone who's working a full-time job at 2,000 hours, it's almost impossible to be a real estate professional to have more
Yep.
hours in real estate than your job. Right. And
Yep.
so people ask, well, what is the point of short-term rental? What do we call it a loophole? What is it all about? And the loophole exists because if you invest in short-term rentals, you don't have to be a real estate professional to use the losses, and we don't care how many hours you're working at your job. There's a whole set of different rules that you can meet to be able to use real estate losses against W-2.
Yep. Yep. Totally. So what are those rules? Like what do people need to do in order to still be able to qualify for these advantages?
So if you're someone who invests in short-term rentals, instead of meeting real estate professional, you have to meet what we call material participation hours. There's 7 different ways to qualify, but we really in practice only see 3 that are most common. Okay. So
Mm.
you qualify to use losses against W-2 income if you and a spouse, if you're married, have at least 500 hours on your short-term rentals. And so that would be setting up the property, managing it, dealing with guest communications, scheduling cleaning crew, even cleaning yourself if you wanted to. So as
Yep.
soon as you have 500 hours, you unlock the tax benefits. Rental losses offset all types of income. Okay.
Hmm.
The other way to qualify for material participation is you have at least 100 hours, but no one else can have more time than you. So example
Mm.
might be Amanda has 110 hours, the cleaning crew only has 60, my gardeners have 20, then great. I have at least 100, nobody else has more time than me.
Hmm.
And then the third way to qualify is I have more hours than everybody else combined. So I add up all the people who kind of helped out in my short-term rental. They added up to 20, and I had 30. Then I also meet material participation. So you only have to meet one of those 3 to unlock the losses against W-2.
Right. And what are some of the most common ways that you see people materially participating? And then how do you recommend tracking those hours that we're talking about?
Yeah, I mean, the most common way to meet material participation is really self-managing, right? And with, technology nowadays, like Hospitable automates so much of that stuff
Yep. Yep.
where sometimes it's silly to pay a property management company if you can do all the stuff, or at least you need it for earning the hours. Another place to earn the hours is rehab. So if you're buying a property that is maybe like a burr where you're going to rehab it, then the hours that you're doing on rehabbing, managing the progress of it, those are also material participation hours as well. Tracking wise, some people find it hard to believe, but the documentation is actually just an honor system. So you tell the IRS you meet the hours, you file your tax return, and you use the tax benefits. Your hours are actually not submitted to the IRS with your tax return. Nonetheless, we still recommend all investors track their hours, because if you're ever audited and the IRS wants to challenge that position, that's the time you have to show them the hours, and they will do what we typically call sample selection. So they'll take a look at your entire time log and pick a couple different dates and times and have you prove that those things were done and the hours are accurate. So there's a lot of different ways to track. There's different apps you can use. We have an Excel spreadsheet that our clients can edit and modify, or people use a notebook or calendar. The kind of a good practice you want to do is to choose one method. Okay, because you'll present that methodology to the IRS if audited, and they'll be able to sample select. What they don't like is, well, there's some time here in my calendar, there's some other time here that's sort of just, in an Excel sheet. Very difficult for them to look at and do some kind of testing.
Yeah, that makes total sense. And then, what does this actually look like from a broader overview of a tax return? And someone's making, let's say, $500,000 a year from their W-2 income. Could you walk us through an example of maybe a previous client, or just a general overview of, what does this strategy look like from a year one tax return?
Yeah, so let's say you're a single person making $500,000 of income. You're probably at, let's say, 37%, right? You're probably at the highest tax bracket. But instead, let's say you put $200,000 down on a property for $500,000, right? And just to keep it simple, we'll assume all of that is building. Normally, if there's land, you have to allocate to the land. But if we say, okay, $500,000 is the building with 100% bonus depreciation right now in 2026, you can expect probably about $150,000 of first year depreciation. And on top of that, for short-term rentals, we obviously always also have to furnish and stage the property too, right? So it can't just be a vacant property. So let's say you spend another $50,000 on, staging and a setup. Maybe we're at $200,000 between cost segregation and depreciating the furniture. So let me do my little math here. So $200,000 at 37% just for federal. And of course, if you're, in California or, different state where there's state income taxes, there's state savings as well. But for simplicity, just say it's federal taxes. That could save you about $73,000 in taxes just with that one property. And it's so powerful because $73,000 taxes saved, that's like a down payment for another property too, right? And you kind of rinse and repeat every single year.
And that's why people are reaching out about this strategy, because of the number you just said. So so I think it's helpful to have that overview and then break it down too from there. So if we have this huge savings potential, what else is needed from a tax perspective to really make sure we're not missing a huge savings opportunity like we just discussed? So you mentioned material participation.
Yep.
What else is needed?
Well, I mean, timing wise, if you're, shopping for property and putting in service middle of the year, great. But what we see a lot is people kind of wait until the last minute to start thinking about taxes and investing. So really important to understand that when we talk about investing in the tax benefits, the property needs to actually be put into service in the year we're trying to use the strategy. So if you're buying something in, October or November, you want to make sure the property itself is listed and preferably have 1 or 2 guest turns during the year so that you can show the rental income on the taxes and you can prove to the IRS that this was a short-term rental in this year. Now, if I bought it this year, I didn't finish my rehab, I didn't get it ready, that's okay. It just means that my tax benefit is delayed a year. I'm going to take it in the following year. Okay, so timing is important. I also think it's important for people to understand what is short-term rental, because people think if I, just list my properties on Airbnb, that's a short-term rental. But for tax purposes, a short-term rental is actually defined as a property where the average guest stay is 7 days or less. Okay, so if it is pretty much a short-term rental for the entire year, usually not a problem. But what we see happen sometimes is a property might be a short-term rental for peak seasons, and it kind of turns into a midterm rental in off-season. And although that's okay to do, you just want to make sure you're staying on top of the reservations so that the average for the year is still going to be 7 days or less.
Right. Which doesn't mean you can't have bookings above 7 days, just the average needs to be 7 days or less.
For
which makes
that
total
year.
sense. And then can we talk about personal use real quick too? Because I know there's some specific rules with personal use. Because a lot of people want to also own a vacation home that they can go visit. So like, where do these personal use rules come into play? What are they? Can you talk about that a little more?
Sure, of course. So IRS does not like personal use. Why? Because personal use usually means you can't write it off. But they do allow you to use you do get some personal use and can still use the short-term rental tax loophole. Right. Usually the threshold is 10%. Okay, and it's 10% of rental days. So for example, if my short-term rental was occupied by guests for 300 days this year, my personal use days should be less than 30 days, right? 10%. If it was rented out for 200 days, I want my personal use to be less than 20 days. If it goes above that, then it's treated as your vacation home. And so it could be hugely detrimental because now our deductions can only offset the rental income. We can no longer create that amazing tax loss to try to offset other types of income. Now, one thing to understand, this is only important in the years that we're trying to use the tax strategy. And so, if I bought a short-term rental this year, I really want to limit my personal use. I want to rent it out as much as possible because I want to get the tax benefits. Next year, though, if I've already taken 100% bonus depreciation, next year, if the property is performing well, I have regular depreciation, I'll probably not have a loss. And in that case, if I don't have a loss, I can use my property more during the year and not be so concerned with personal use issues, right? So it's a year by year thing to just kind of be aware of too.
Yeah, no, I'm glad you clarified that. So just looking at it holistically, so we keep our average length of stay to 7 days or less. Personal use, if you want to use it, you still can, but it should be less than 10% of the available rental days or the rental days that have been booked by guests.
Yeah, I will say for personal use, just to kind of round out that concept, personal use days are defined as days where you or friends and family are there staying for less than fair market value. Okay, so if you let your parents stay there or your friends for really cheap, that's also considered personal use day. What is not a personal day is the days you're staying there to work on the property. Okay, so and when we're setting up the property, if it's not local to us, we're probably going to stay there for the week or the weekend to get it all set up. Those are actually not personal use days. They are considered business days. So really important to understand. Because we've had people who say, hey, I'm going to rent a hotel while I work on the property. It's like, no, you don't need to do that.
Yeah, save your money. Yeah, and then on top of that, you're qualifying for the material participation hours while you're able to stay at this property. What else do you want to see as a CPA if someone comes to you? Like, what do you want to make sure they are providing to you if you guys are going to work together?
I mean, tracking expenses is probably one of the most common, mistakes made by investors, right? Just not knowing what to write off and how to track them. It's really important to understand that when you start investing in real estate, you are a business owner in the eyes of the IRS. And I don't mean business in the context of LLC, right? You could have an LLC for asset protection, or you could not have an LLC. It doesn't really matter. But the write-offs are because you're in the real estate investing business. So travel expenses, fees you pay to join, a membership program, right? Continuing education, learning about how to invest in real estate, buying books about real estate, traveling to conferences, business use of your car or your home office. Yeah. All those are things you want to make sure you are tracking and understanding, working with your CPA proactively, right? So you kind of know, before I go on this trip, is it a tax deductible item? If not, how can it be? What are the things I should put in place to make sure that I can write it off?
Yeah. And what do you think is the most effective way to be tracking those expenses as a business owner or real estate investor?
Yeah. And that answer really depends on the investor themselves. I would say use the method that you are most comfortable with, because only then will you be using it consistently. So meaning if I'm someone who's, I love Excel, then track it in Excel because you're going to be really comfortable doing it. If you're good with different kinds of software, QuickBooks is great. You can sync it with your bank account, your credit card account. It will download and automate a lot of that bookkeeping process for you. But again, if you're not good with technology, what I don't want you to do is sign up for QuickBooks and then be fearful of it and then end up like not doing anything at all, right? So it's just whatever makes the most sense that you're comfortable with.
Yeah, totally makes sense. Do you recommend a bookkeeper, or is that something you typically see most of your clients do on their own?
I think it depends on the client. If somebody doesn't mind doing it and they have the time to do it, great, right? If you self-manage your properties, bookkeeping time counts as material participation. So what a great way to save money and also earn the hours. But I have clients who are like, you know what, I hate accounting. I never want to learn it. My time, if I'm a doctor, my time is best spent, doing medical stuff. Then absolutely, bookkeeper is a really great way to leverage, their time to help you track what's important in your real estate investment.
Yeah, that makes a lot of sense. And like you said, a lot of these people, their dollar per hour might be much higher than it would be to hire a bookkeeper, and they're still going to qualify for material participation. So I agree. It totally depends on the person and their situation. Yeah. So how about just in general, like mistakes? What are some mistakes that you've seen? Does anything come to mind as people are trying to go about this for maybe the first time, and there's a mistake that's repeated itself for some of your clients where you're like, hey, maybe we can prevent some other people from making this mistake?
Sure.
And either getting audited or missing this tax benefit.
Yeah, I'll give you, I think we can break it out into investor mistakes and then like CPA or accountant mistakes, because they're kind of two different categories. On the investor side, we touched on one, right? Just not knowing and tracking legitimate expenses. So we want to make sure we do that. Another mistake I see from an investor's perspective is not utilizing legal entities correctly. I said earlier, right? We don't have to have a legal entity for tax purposes, but you certainly, for asset protection, usually you want to have some kind of entity surrounding that. And so it's beyond just setting up an entity, but it's actually utilizing it. So when I have an entity, title of your property should be held in the entity. Entity should have a bank account. And so money from Airbnb should go to that entity bank account. Tax documents issued in the name of the entity, right?
Right.
And so those are those, a lot of times people think, well, that's just kind of like small documentation stuff. I don't really care. But it does come into play with respect to making sure we minimize our audit risk because the paperwork matches. And in the future, when you sell, if we want to defer taxes via 1031 exchange or something, really, really important that how it's reflected on your tax return is kind of how title was held and how you intended kind of everything to flow through together, right? So implementation and usage of the legal entities is also another important one. And I will say the last one for investor mistakes is probably putting too much emphasis and weight on the tax piece of it. I know that's strange for me to say as a CPA, but justifying an underperforming property because I'm getting tax savings. Because tax savings is a one-time thing, right? We're going to get it one time. But if you have an underperforming property, that's underperforming for maybe years to come. And so always make sure you understand, first and foremost, we're trying to make money from investing.
Yep. We've seen clients do the same thing where they're like, we don't want to get crushed by taxes. So then they qualify for the year one deduction, but then they hand it off to us and they are not cash flowing anymore. And they're in the red, and then they're stressing out. So they're stressing us out. We're like, you should have underwritten this deal better from the beginning rather than just relying on that tax benefit. And then can we talk about after year one real quick? So what happens? You get this large deduction in year one. What happens after that?
Yeah, you'll still get depreciation. A lot of people think, after that, I don't get any more write-offs. So you'll still have your natural write-offs, right? Interest, property taxes. You'll still have your operational expenses. And even depreciation, you'll still continue to depreciate what was assigned to the building component. Because when we buy a $500,000 property, I'm not writing off the whole 500,000, right? I'm writing off what I legally can that's been assigned to something that's not building. But I'll always still have some component that is building that will continue to depreciate over the life of the property. So we'll still continue to get benefits. It just won't be as amazing as that first bump you got in year one.
Right. And then there's a term, depreciation recapture. Could you talk us through that and what that is and how you've seen clients effectively navigate that?
Yeah. So depreciation recapture in the simplistic form is saying, hey, I already wrote off part of my purchase price of the property through depreciation. So when I sell, I can't write that off again. Okay, so if I bought a property for 500,000, I sold it for 500,000, there's no gain because I didn't do anything at all. But if I bought it for 500, I already wrote off 100,000 through depreciation. Well, now my basis is 400,000. So when I sell for 500,000, there's a gain of 100,000. That's what's basically the depreciation recapture component. I know there are a lot of CPAs who say, don't take depreciation because you have to recapture it anyway. That's very terrible advice because you have to take depreciation. It's actually not a choice. So in other words, if you don't take depreciation, IRS could still recapture the taxes as if you did. So we always take depreciation because it is a requirement, not a choice. And also, when you sell property, there are so many different ways you can defer the taxes or offset the taxes with better advanced planning that it doesn't always have to come back as this big, tax hit when you sell the property.
Yeah, good to know. So holistically, it really sounds like, it's talking to someone like yourself at the beginning because, we're talking about a lot of different concepts right now, but really having someone like you in your corner is going to be most helpful. So what does it look like to work with you and your team? What's that engagement look like? What's the timeline or timing for that as well?
What's really interesting is people always ask like, oh, well, should I do planning after I've closed on my first short-term rental or do I pre-plan before I buy my property? And my answer is always, you want to start planning as early as you can financially. Okay, so if I have no money, I have to buy my short-term rental, get cash flow to then plan, so be it. It has to be done that way. But if you have the financial ability to do so, planning should happen prior even to the acquisition of the first property. Why? Because where you buy your property, what kind of property you buy, has a huge impact on how much taxes you save, right? If I buy a turnkey out-of-state property where I never can spend any hours, well, guess what? You're not going to get the tax benefit because one of the things we said is you need to have the hours. If you buy a property that is oceanfront, where most of the purchase price is land, you can have very little tax benefit. And so the planning helps you to also optimize the type of property that you buy or should buy to get the tax savings associated. Planning wise, believe it or not, even though, we're talking about short-term rental tax strategies, true tax planning goes beyond just the real estate because it is the interaction between how are you earning your income with how are you investing your money to really bridge the two, right? So if you're a realtor versus if you're a doctor or you're someone working in tech, that's a different set of strategies we would look at with respect to even real estate, right? So our process is somewhat involved. We review people's tax returns from previous years to identify missed opportunities or exposure areas. We, get access to all of your, bank accounts and debt, investments, retirement. Because again, I know we're talking today about short-term rentals, but all of that play together in terms of how do I maximize my tax savings and also how do I put my money to work? Where should I get the money to invest in my short-term rentals? Should I HELOC against my home? Should I sell my stocks? Should I borrow from my parents, borrow from my friends? Those all have different tax implications.
Yeah. So reach out to Amanda and her team as soon as you see this. And then just final thoughts, like what's one thing you wish every STR investor understood about taxes before buying their first property?
Gosh, I'll say the one thing for people to understand that just buying the property itself is not enough. There are things that you need to be doing and documenting to legitimately use the tax strategies. I've come across people who've said, I loosely qualify for the hours, and loosely is not a good way to try to get the benefit because short-term rental investing you're usually saving close to six figures in taxes. And not, it's like I'm saving $1,000. I loosely qualify. I don't know, right?
Yeah.
If you're saving, or you're writing off typically, at least you're writing off six figures against your taxable income. So you want to make sure you're doing it correctly. You don't want it to be kind of like a Mickey Mouse job, because if you're audited and you don't meet the standards to actually qualify, the taxes, interest, and penalties could be very, very painful. So do it correctly from the beginning.
Yep, love that. Well, you give amazing advice. Thank you for your time here. And we will have a link in the show notes for all the students watching this, and that's to connect with Amanda and her team at Keystone CPA. So that link will be down there. And thank you again, Amanda.